Okay, this is the second problem we had in chapter number 1. This is transaction analysis, and what we have is we have a lady here, Jasmine, and Jasmine is going to start a business, and this business is going to be called Expressions. And Jasmine, this is her first month of operations, and this goes from August 1 to August 31. And Jasmine's going to contribute some money, she's going to do some hair cutting, she's going to get paid, she's going to buy some supplies, she's going to pay some rent, and she's going to do a variety of things that any business would do. And we're going to put this in a transaction analysis. This is the only chapter we're going to do this. The purpose of this problem, everything we do here is going to have a purpose. And the purpose of this is to get you, the student, to understand that every transaction has at least 2 parts. The first transaction is actually going to have 3 parts to it. So I'm going to walk over to the board here, and we're going to go through the transactions of Jasmine's company, Expressions. And you should have already had in your handout across the top a listing of different accounts that Jasmine's company has. Cash, accounts receivable, furniture, equipment. There's going to be an account for a liability, note payable. Equity, there's going to be the capital account and the withdrawal account. And we're not going to separate out separate types of revenues and expenses. We're just going to use one category for revenues and another column for expenses. And then down the far left side here, A, B, C, D, all the way down to K. And those are going to be the individual transactions. And so if you look on your paper for this transaction analysis, August 1, Jasmine invests $3,000 cash and $15,000 of equipment. What impact on these accounts? Well, there will be a positive $3,000 as to cash, because cash went up in the business. The equipment also increases, so there's a positive increase of $15,000. Also note that since Jasmine put these assets into the business, her equity or ownership interest went up by $18,000. So assets went up by 18, equity went up by 18. And in our accounting equation of assets equal liabilities plus equity, we have assets of $18,000 and equity right now of $18,000. The equation balance. The next transaction, item B, is that Jasmine's business, Expressions, pays $600 cash for some furniture. So what happens here? Well, the cash is going to go down. So I'm going to put that in a bracket. Cash goes down. And I'm going to come over and I'm going to say, what else happens? Well, equipment goes up by $600. So we have now $2,400 of cash. $3,000 less the 6 is $2,400. Plus we have $615,000. If we add all of that up, that now adds up to $18,000. Assets of 18, no liabilities, and the cash and the capital is 18. Now I just made a mistake, but it's a mistake students often make. They think that $18,000 in capital is cash. It's not cash. It happens to be the equity ownership of the owner. Where is the cash here? It's right here under the cash account. That would be like saying your car, of which you paid $5,000 and have, let's say, you paid $5,000 for, is cash. Well, the car isn't cash. You could turn the car into cash, but the car is not cash. So cash is listed here. The capital represents your ownership interest. Item number C, Expressions pays $500 cash for rent. Well, again, cash is going to go down now, $500, and I bracket that. What else up here is impacted? Well, that outflow is an expense. And so I happen to have an expense of, that's $500. And that, we'll just say that's rent. All right. So cash goes down, the expenses go up. Well, you say, hey, I thought that equation assets equal liabilities plus equity. But what impact does expenses have on equity? Expenses cause equity to go down. Assets are going down, equity is going down. The balance sheet equation remains equal. Let us look at item D. On August 4th, the company purchases $1,200 of equipment on credit. So what's going to happen is we happen to have a positive under equipment, $1,200. So assets are going up. What's happening on the other side? Liabilities are also going up. Assets go up, liabilities go up by equal amounts. The equation A equals L plus E still balances out. Well, let's go down to the next one, and we're now down on item E. On August 5th, Expressions opened a business. Cash received for services provided in its first week and a half are $825. So we get $825 for cash. So we put a positive $825 under cash. And where did this come from? Well, it happened to come from a revenue generating activity. So we come over here and we add $825 to the column revenue. So how does this equation A equals L plus E balance? Cash has gone up, that's an asset, so it goes up. How about the other side of the equation? Revenues have gone up, and what impact do revenues have on equity? Causes equity to go up. So the equation still balances. Down to item F. Now we're halfway through the month, we're on the 15th. The business provided $100 of haircutting services to parties on account. All right, well that account is called an account receivable. So I have a positive 100 under the column for accounts receivable. I also have a revenue, a positive 100 under revenues. This transaction is important, again, to understand that accounts receivable is an asset. The accounts receivable came from a revenue generating activity, but the revenue is listed under revenues. We have two parts, at least two parts to every transaction. We did some services, we have a revenue, and the person that we did the services for gave us an asset, an IOU in this case, an account receivable. The account receivable is the asset. The accounts receivable is not the revenue. We are also using here the accrual method of accounting. The accrual method of accounting, which we will talk about more in Chapter 3, says we recognize revenues when we earn it, not when we receive it. We haven't even received it yet, but we're booking the revenue out. Okay, the next transaction is on the 17th of August. We receive $100 for the services that we previously rendered on account. So this $100, when we did the service, we put it in as an asset, they're now going to pay us. So I add $100 here to assets. Now, a lot of students right here want to run over and they want to book out another $100 for revenue. Well, you'd be the friend of the Internal Revenue Service because you'd be booking revenue out twice. Once when you earn it, and then once when you collect it. You would be doubling your income. That sounds good, but in reality, you wouldn't have any more income. We recognize income when we earn it, not when we receive it. So what's the other part of this transaction? The other part is the receivable goes down and we show that they don't owe us anymore because we don't want to bill them again. So this is when we put it on our books, when we earned it, and then they paid us. We don't have revenue. That's just changing one asset for another asset. All right, we're coming down to H here, and on the 17th, we paid $125 cash to an assistant. So cash, $125. I'm putting it in brackets. That's an outflow. And what is that called? That's going to be called wages. That's an expense. So $125. Wages. Now, that means expenses went up, but again, as expenses go up, what happens to the equity? The equity goes down. Cash is going down, assets, liabilities are not being impacted, equity is going down. Assets equal liabilities plus equity. The equation remains equal. Hasn't changed. Let's go down to I. In I, on the 31st, cash received for services provided for the second half of the month, $930. All right, I got some more cash, $930. What's the other side of that transaction? That's another revenue, $930. Then we also, on the 31st, the business paid $400 installment for the note. So $400 is paid, cash goes down. And what happens over here under the note? The note is going to go down because we paid off part of that. So we're going to put $400 reduction of that note. And the last thing is the owner takes out $900 in the business. Wow, what are we going to call that $900? Some students would say, let's put it under expenses. Just like when we pay our employees, that's an expense. But the thing we want to know is withdrawals of the owner are not an expense. So we're going to come over here and we're going to say that withdrawal is right there. All right, under withdrawals. Now, the last thing I'm going to do here is I'm going to total all of these columns up. And I'm going to do that, and then we're going to talk about the different financial statements. So I'll be right back in a second. Okay, we're back, and we happen to have those balances all listed across here. And you can see that what I've done is I have the ending cash balance, I have the ending receivable balance, the ending furniture balance, the ending equipment balance, the notes payable, the capital, the withdrawals, the revenues, and the expenses. And what I'm trying to help you understand is that we happen to have three financial statements that we're going to be using. The income statement, the statement of owner's equity, and the balance sheet. Now, the statement of income is the revenues and the expenses. And over here, we have our revenues and expenses. That statement is for a period of time. Now, here in the business expressions, we started out with this first transaction on the 1st of the month, and we had this last transaction on the 31st of the month. So on the income statement, we are capturing all of the revenues and all of the expenses for the period of time. So in our case, on the income statement, we will show revenues of $1,855 and expenses of $625. And the difference between those will happen to be our net income. The other financial statement is the statement of owner's equity. That is also for a period of time and is exactly the same period as this income statement. What will be on that statement will be our beginning capital. $18,000 was our investment during this period of time. It will show the difference between revenues and expenses, the net here. That will be added to the capital account. And it will show a reduction of the withdrawals. And the net of that, the net of everything from my hand over, 18 less the 9 plus the net income, that will give you your ending owner's equity. The balance sheet is assets, liabilities, and the ending owner's equity balance. That is for a point in time. And what I'm trying to instill in you is the following, is that is just this point in time right here. It's these balances on August 31st. We will have cash of $2,300, no receivables. We will have the furniture of $600. We will have the equipment of $16,200. So those are our assets right then. We will have the liabilities of the $800, and we will have the net of these four figures right here, and that happens to be the ending capital balance. So what did I want you to get from this exercise? And again, we won't be doing this other than in homework. We won't be doing this in any other chapter. What I'm trying to get from you is as follows. Every transaction has at least two parts. That we are going to use the accrual method of accounting, so we recognize revenues when we earn it, not when we receive it. That the income statement is for a period of time, and that period is also the same period we have the statement of owner's equity, and the balance sheet is for a point in time. It's the end of that period. All right? So that is the last problem we will be doing here in class for chapter number 1.